All right, put your phones down. Class is in session. I am not a financial advisor, and this podcast is for informational and educational purposes only. The content discussed here is not intended as financial, tax, or legal advice, as well as investment advice. Always consult with a qualified professional before making any financial decisions. Past performance is not indicative of future results. All opinions expressed are my own. Aloha and welcome back to Class Time. Today I want to talk about something that most investors completely ignore until they can't ignore it anymore. And by then, the moves have already been made. We're talking about the materials that literally make the modern world run. AI needs them. Fighter jets needs them. Your electric vehicle, your solar panel, your phone, all of them. I'm talking about rare earth elements and copper, and why right now in 2026, these two asset classes might be the most important thing you're not paying attention to. So what are rare earths? Don't let the name fool you. First, quick vocab lesson. Because the name is misleading, rare earths are not rare. There are 17 of them. Elements like, well, things I'm not going to start twisting my tongue over right now. I know, but here's what you need to know. They show up everywhere, inside every permanent magnet, the kind of that spins the motors in your electric vehicle, the turbines in your wind farm, the actuators in military drones, inside every smartphone, every hard drive, every defense radar system. So why do people call them rare? Because even though the elements exist in the ground in many places around the world, the availability to actually, the ability to actually process them is extremely hard, and it's also extremely concentrated. And that's where it gets geopolitically spicy. So here's a simple supply chain, right? If you can kind of imagine it. You mine the ore, you separate and refine the rare earth oxides, you turn those into metals and alloys, you manufacture the magnets. China dominates in steps 2, 3, and 4, overwhelmingly so. We're talking about 60 to 90% of the global processing capacity, depending on the specific element. That's a single point of failure for the entire Western industrial complex. And the US government knows it. NATO knows it. Every major defense contractor knows it. That is a single point of failure for, well, the world as we know it. The three major drivers for rare earths. So here's why this isn't a long-term story. It's a right now sort of story. Three things that are happening simultaneously. We have AI infrastructure. Every time you use ChatGPT, every time a data center turns an interface, that requires power. Massive amounts of power. The data centers being built right now for AI are using rare earth permanent magnet motors in their cooling systems, power management, you name it. NVIDIA is building, Microsoft is building, Amazon is building. Each one of these hyperscale data centers is a demand event for rare earths. Next, we have defense and national security. This one's not optional. Every F-35 contains roughly 900 pounds of rare earth materials. Every Tomahawk missile, every guided munition, every radar system. After COVID exposed how fragile the global supply chains are, the US passed the Inflation Reduction Act, the CHIPS Act, and several defense appropriations, specifically to reshore critical mineral supply chains. That's government guaranteed demand. And here's the kicker: the Pentagon has been buying up strategic reserves, and they don't do that unless they're, well, concerned in some way. Here's the next and last driver: electrification and the grid. Every electric vehicle needs about 2 to 4 kilograms of rare earth magnets in its motor. Every offshore wind turbine uses about 600 kilograms. As the grid electrifies, whether you believe in the pace or not, the demand trajectory is one directional. So you've got AI pulling from one side, defense pulling from the other side, and the energy transition pulling from the third direction, as well as supply being constrained. So if you do the simple math, we've got a bit of a, well, pop about to happen. You've got AI pulling and defense pulling and an energy pulling, and, well, then you don't have enough of something. Like I said, do the math. Also, you got the unsung hero here, copper. So let's talk about it for a second, because copper doesn't get the hype of lithium or rare earths, but it might actually be the most important of all. Copper is the universal conductor. Everything that moves electrons, power lines, transformers, electric vehicles, solar panel wiring, data center cabling, it runs on copper. Here's a stat that should stop you cold. A conventional car uses about 23 kilograms of copper. An electric vehicle uses about 83 kilograms of copper. An offshore wind turbine uses 4 tons of copper. A single large scale data center could use up to 20 plus million pounds of copper wire. And here's the supply problem. The average time from copper discovery to production is 16 years. 16 years. You cannot turn on a new copper mine very quickly. It doesn't work that way. So we have a structural supply gap that's sort of baked in. No matter what happens with demand, the supply side cannot respond fast enough. That's a setup investors should understand. The investment case, though, and a few risks, of course. Now that we've gotten what's important, well, sort of important, this is also doubly important. The strategic importance does not automatically mean easy money. VanEck said it in their own video, actually. Long-term strategic importance doesn't always translate into straightforward investment case. And I respect that honesty. We're going to be covering that content after I conclude some of this section here, because I'm not going to try to rehash what they said. They know it best, so we're going to watch them together. But here are some of the real risks. China retaliation or, well, flood. China could dump rare earths on the market tomorrow and crater prices. They've done it before. 2010 through 2012, that wiped out Western rare earth producers. Linus, an Australian miner, nearly went under. Risk 2, valuation. Some of these mining and processing companies run up hard on headlines. MP Minerals, for example. It's the only major rare earth miner in the US. It trades on narrative as much as fundamentals. You can be right on the thesis and still be wrecked on timing. Here's the next risk, number 3. Substitution. Engineers are always working on ways to reduce rare earth content in motors. It won't eliminate demand, but it could dampen the ceiling. So, what do you want to do with that? You don't ignore the sector, you size appropriately, use ETFs to spread the risk. We're going to go over some here in a little bit with VanEck. And you pay attention to the, well, whatever indication structure you like to use before you enter that position. Moving average, Ichimoku structure, it's really up to you. But if you've been in, well, this class or any class long enough, you know how we do things here. So here's the next thing we're going to do, how we're going to play this. Here's where the lesson meets real life. The cleanest ETF exposure to rare earths is ticker REMX. That's the VanEck Rare Earth / Strategic Metals ETF. That's actually one that my trading desk, Kairos, picked up, as well as something I personally trade as well. We're in it. It didn't work out particularly on entry for the Kairos trading desk, but the thesis is still more intact than it was when we entered that trade a few weeks back. For copper, you're looking at the ticker COPX, or Global X Copper Miners ETF. You could always go with ticker DBB or the Investico DB Base Metals Fund. For a broader critical metals play, you could pick up ticker PICK, which is iShares. It gives you something more diversified. None of these are slam dunks. I'm not an investment advisor. I don't give advice. These are just things that are exposed to broad markets, and that's less risky than single company or single stock picks, especially when companies could be just trading on the news rather than on actual fundamentals. But just keep them on your radar moving forward. We need these metals and minerals and rare earths. So drop it in the comments if you've traded any rare earth or copper plays, whether it's REMX or MP Minerals, Freeport, McMoran, anything. Let me know what you're working with. Here's some of the big picture. Before we get into the actual education section here, I'm going to leave you with this. Every major technological revolution has been built on a mineral or material of some sort backbone that most people ignored until they couldn't ignore it anymore. The Industrial Revolution ran on iron and coal, the 20th century ran on oil and steel, the Digital Revolution ran on silicon. The 21st century, where we're standing here now, the AI century, I think, the defense autonomy century, maybe, the electrification century. It all runs on rare earths and copper. It really doesn't matter which one we end up with. The countries and companies that could control or currently control those supply chains will have enormous leverage. The investors who understood that early, like me and hopefully you, like always, have positioned before the crowd figured it out. Now, here's the intro. Now let's get to the actual lesson here. We're going to be hearing from Andrew Musgraves and friends from VanEck. Mahalo for sticking around. Now let's hear some content and some education from the professionals.
It's rare earths,
All right, here we
copper, their
go.
roles in powering AI, defense, and grid build out. Of course, we've already covered this at length in many of our previous webinars, how these metals are vital to AI build out, our defense systems, aiding with electrification more broadly. So instead, we really want to make sure that our discussion isn't focused just on those, although we'll touch on it briefly, but more so kind of what we anticipate as coming up next. Things seem to be rapidly evolving day to day in this area. So, of course, the narrative up to this point has been that the U.S. And other countries are kind of racing to secure supply of rare earths in order to combat China's dominance. And while that has been something that's playing out in the market, many are starting to realize that there are extreme challenges with doing so and an incredible cost and some complexity associated with this undertaking. So we want to dig into that a bit in detail while also looking to keep the discussion centered around several core topics. Ideally, we're at record highs in copper and near record highs in rare earths. So how did we get here? The race to secure rare earths looks more like a marathon and a necessary coordinated effort among multiple stakeholders. So how's that going to work out? How can we expect that to happen over the next several years or decade even? And third, there's lots of ways to access the opportunities emerging from this. And so we want to explore what the best expressions are of those opportunities. And we'll touch on all of those today. And to do that with me is our senior analyst and metals expert in mining, Charles Milan. Charles is part of the active resource equity team here at VanEck. Been with the firm for over 20 years now, 30 years in the industry, lots of experience in the space, perhaps most importantly, lots of experience talking with the management teams of these companies every day. So a great grasp on what's most critical in the markets today, and for sure someone we're excited to speak about on this topic. So quickly just highlight VanEck's own resource equity experience too, including decades in resource equity markets and mining specifically with one of the first gold equity funds in the nation. Also today, one of the largest offerings of active and passive global resource offerings, including sector-specific strategies in oil and gas and gold, base metals, agriculture, collectively assets totaling around 70 billion across a variety of vehicles, including ETFs, mutual funds, and separately managed accounts. So let's get into it, Char. Let's start things off. We've been seeing copper and rare earths again reach all-time or near-time highs. We suspect that at least some of this has to do with the long-term ongoing developments in these markets, but maybe, Iran conflicts, rapid AI adoption. How are we kind of distinguishing between what the impact has been from some of these longer-term catalysts that have been driving metals prices and what's been the result of more recent factors emerging over the last several years? So really, how do we get here today?
Sure. Thanks, Andrew, and welcome everyone. It's an honor to talk to you and present you today about the rare earths and the copper space and some other opportunities we see in this environment. Andrew, you make a good point there. Like, there's a lot of long-term structural issues within the resources space, and as some of the geopolitical events in the short term has exposed some other structural issues that we need to sort of figure out. So if I can sort of address it in three things as you sort of bring up in that slide, where are we today? I would start off with just the geopolitical event being around, and I think the most important thing out of that is that it's exposed the vulnerabilities that we have within the commodity supply chain. And although energy and crude has most probably taken the spotlight over the last couple of months, the impact that we've seen from this event has been much broader and it's been very deep into the metal space. And I'll get into that in a little bit later. But again, the point is here, where we are today is the vulnerabilities of the supply chain is consistently being exposed through a range of different events. Because of that and some of the longer term structural issues that we are seeing is sort of what do we think is going to happen next. I believe that there's going to be continued supply pressure on volumes specifically. That's more of a longer term geological issue, but there's also going to be pressure on cost in producing these different commodities because of some of the short-term geopolitical events that we've had. And I think that actually could be a very supportive environment for commodity prices as we see it now. And then just to address some of the opportunities we see it, quite honest with you, I think from 6 months ago to today, we see a much broader opportunity set across the entire resources base. It's not just for us anymore, just the metals and mining space. I think it's much, much broader, like I said to you. I think it is important for investors to not only note that it's numerous and it's broad, but they're going to have to be very selective on how they approach this. A lot of what I'm going to be talking about and that you will read in the press are being discounted by some of these companies and some of these commodities. So again, selectivity on how you approach the space is going to be quite important from here forward.
That's great. And yeah, I think we wanted to start off too here. Thank you for frameworking that for us. Maybe just kind of digging into the details a little bit about what's going on with rare earth prices, right? It's, as we kind of note right here, you're seeing quite some volatility in these prices, but the rationale for that. So maybe you can speak a little bit about that.
So nothing has changed, but a lot has changed is the summary of this slide. So first of all, what you're looking at there is the price chart of NdPr, or the proxy for rare earths is the way to think about it. And the volatility that we've seen in this price chart is really driven by geopolitical concerns. You know, we can go back to 2008 when these geopolitical concerns came to the fore for the first time. And over the last couple of years, this has just become more of an issue. And really what the issue is, as you most probably know, and as we've spoken about before, is that China controls 80+% of rare earth supply. And what China has done over the last couple of years is they've actually put controls on exports of rare earths as well as equipment to make magnets for this. So that's why price action has been like this. Most recent state visit by President Trump, I believe it was now 2 weeks ago, we actually anticipated there could be some relief on these export restrictions from the Chinese, but that did not occur. So we expect that the sort of price level that we're seeing at the moment is going to be maintained. And just to put this in context for you, this price level is about $110 a kilogram, which is a similar price to where the current US government and other Western governments have agreed to set a price floor for rare earths. And what this has meant is that because they see this industry as an industry of national and economic security, companies, domestic companies, Western world companies, are actually able to ramp up their production. We've met with a number of government officials over the last 2 or 3 months, and the topic of national security and economic security within the metals and mining space was a topic that has been frequently discussed, was probably the #1 topic over the last 6 months in my universe, I would say.
No, I'm glad that you brought that up. I think one of the things we just wanted to rehash for folks was sort of all of the sub-industries that you know, rare earth has its hands in. So you know, we provide a chart right here kind of showing the depth of it in terms of its tie to US GDP. I don't know if you want to comment on this or just the substitution, you know, problem that a lot of these industries are facing, particularly the ones that are you know, a major consequence here, like you mentioned, you know, semiconductors, defense, right, refining, things like that.
So what you'll see if you look at that chart, the sort of industries that's highly concentrated within or highly dependent upon these rare earths are really the aerospace, defense, electronics, communication, and transport. So it's a highly concentrated industry. It's a very strategic industry, but the most important thing out of this chart most probably is that the substitution within these industries for a different metal or different mineral is very difficult, very hard to do. The way I frame rare earths in general, it's a very small impact, but it has a very outsized impact on the economy or on national security. I mean, that number of $1.2 trillion is roughly about 4% of the US GDP is what the rare earth industry touches. And so, like I said to you before, we are continuing to see, and we've seen a number of things in the last couple of days of Western governments investing in increasing capacity. We've seen that the US officials in Washington have employed, or the US organizations within Washington have employed more employees to be able to understand what's going on with industry. They're opening up regional offices around the world so they can get a better access to that. And I think, as I said before, there's increased frequency of meeting with investors like ourselves so they can get a better idea of what the lay of the land looks like. The important thing here is that what the Western world's trying to do is they're trying to reduce the dependency on imports, firstly. And secondly, we've now again seen the vulnerability of the supply chain on many, many different levels, and we're trying to get away from that. And that requires years of investing in mining, separation, refining, magnet manufacturing, recycling, and a range of other industries.
Yeah, I think it's important what you point out there, right, in terms of it being a multi-year effort to try and kind of reduce some of that supply vulnerability. Of course, you know, you mentioned defense. Maybe you can just hop into it a little bit more. And of course, we've spoken about this in the past, maybe a little bit deeper of a dive just into how critical these are to some of the components of, you know, some of the missile defense systems and aircrafts and other defense apparatus that you know, we rely on.
Yeah, happy to do that. I think the key thing to note here is if you think of rare earth magnets, or what they call permanent magnets, there's really 80 different grades or qualities of rare earth magnets, so 80. And you measure them based on two things. The first thing is on the energy or the strength, so how strong they are. And then secondly, on the heat they can withstand. So stronger, more heat, more expensive, higher margin for companies, more in demand, hence not able to be substituted, as I showed in the slide before. Defense is most probably the one that fits that, or defense demand or defense applications is most probably the one that's the biggest consumer of that high strength, high heat type of magnets. And we are, well, not we, the sort of consensus street estimates are that the growth rate of defense in permanent magnets is somewhere around 15% compounded average growth rate. And then robotics, although it has a lower magnet in the sense of requirement regarding heat, it requires a very strong magnet. And with robotics rolling out, and you know how many places we have robotic applications now, the estimates are sort of that the compounded average growth rate of that is around 20, 29, 30%, somewhere around there. If you wrap all of this together, and so we look at transportation, defense, robotics, communication, and a range of other things, the estimates is that we will or could see demand for permanent magnets over the next 10 years sort of grow by 2.5 to 3x from where we are currently. And that will require external supply outside of China.
Which is maybe what leads us into this discussion, which is sort of the ex-China supply chain, right?
Yeah.
We've kind of seen it growing, a lot of companies popping up now. You know, how are you thinking about that, and where are we at currently with our U.S. supply chain?
Sure. This speaks directly to what I just spoke about, getting away from Chinese supply. And if you look at on a very if you look at the very top of that chart, you'll see the little red and blue pie charts. The red is the supply that comes out of China, and the red is the supply out of the Western world. So clearly China controls sort of all 4 or 5 of these different verticals itself. What we've seen over the last 12 months, again, is we've seen that sort of first vertical, the mining separation vertical. We've seen a lot of investment in that space. You will remember things like MP Materials was a big headline about 6 or 8 months ago, where the government's spending a ton of money in it. That's also where the floor for an NdPr pricing came out. So we spent a lot of money on that, and I think we will get more announcements into the end of the year of the government actually allocating money into that space. And that's great. But the real opportunity doesn't sit there for me as I look into this. The opportunity actually sits to the right of it. So it sits into the separation, alloys, magnets, and then lastly, the recycling side. Ideally, we need to get, ideally as a company, ideally as a Western world, we need to get in a place where we can be a fully integrated supplier. So effectively, all the way from mine to magnet. So we got to mine the rare earths, we've got to have the ability to make the rare earths. And as you can see from the sort of chart that you have up there, there's not a lot of companies outside of China, and there's a lot of reasons for it, right? It's first of all lack of IP that we have. Secondly, lack of profitability for many, hence the flaws that I spoke about before. A lot of these companies are actually private, and so these are some of the issues. Most probably the best example of what I think will happen as we move into the future, and this is a transaction that's still taking place, is a company called US Rare Earths. They are aiming to become a fully integrated rare earth company, similar to what MP Materials, similar to what Linus is trying to do. They just recently did a big transaction on Sierra Verde, which is a mine. They do own Caristers, they do own LCM, which is the sort of separation and the magnet manufacturing side of the business. So that's where we are. I think the big other portion that we're not focusing enough time on is in just pure recycling. China produces 30% of its permanent magnets from recycling. Let's just think 30% comes from recycling. And I don't mean end of life recycling, I mean factory floor recycling. So relatively high margin, easy recycling. And again, that's an industry that as a Western world, we've not spent enough time or money on to really develop well.
It's an interesting point, and something I'm sure we'll be keeping an eye on as the industry continues to evolve and develop. I did want to pivot really quickly because I know we're kind of speaking about rare earths and copper. We didn't really get a chance to kind of evaluate copper in isolation here, but it's probably worth doing so because of how different this metal reacts to different drivers and supply constraints. So maybe you can kind of just set the stage for us where we're at with this this particular metal, since it's rallied to all-time highs.
Yeah, of course. So where we are today. So if you think back a couple of months ago, we did the presentation. I dug quite deeply into the supply risks within the copper industry. Now, I'm not going to get into all that again, but I will just highlight some things I spoke about then. As I spoke about, the grades were lower. That's a consistent structural issue. I spoke about projects being delayed and how that continues to be a persistent thematic that we see across the industry. In addition to that, we are now obviously seeing some of the supply constraints out of Iran. So again, like I said before, as we all talk about energy and crude impact on the current war, but the copper industry requires a lot of sulfuric acid, which the Strait of Hormuz is one of the biggest suppliers, or the area is one of the biggest suppliers of sulfuric acid. And about 12% of the supply of sulfuric acid, by the way, that 40% of global supply out of that area, 12% of that 12% in general goes to the mining industry, of which is the majority of the copper industry. So just think of it for a second, like people spoke about, are we going to get diesel prices substantially high? Within the copper industry, not only did we talk about diesel, we also talked about sulfuric acid, because if you can't get your hands on sulfuric acid, you cannot produce any copper. One issue within the supply conversation we didn't have a couple of months ago. The other issue, and this sort of feeds back to what I believe there's a structurally better cost support structure for things like copper, is sulfuric acid prices is up 200% since we last spoke. So clearly, I believe copper, and there's a number of other commodities that sits in the same bucket with the same issues, are well supported because of A, supply constraints, B, production cost issues. And for me, the risk at the moment within this industry lies more on the demand side and what happens to demand than that it is actually on the supply side.
I think the next few slides we have probably recap a lot of the things that you spoke about in the last webinar that we did. For folks that are participating, did not see that webinar, maybe we can throw up a link for you guys just in case you missed it. But yeah, talking about copper supply becoming increasingly capital intensive, fewer major discoveries. So maybe just hit on that quickly so we can save enough time to try and cover what's next for these industries.
Sure. So this is the structural stuff that I'm talking about, geology, right? And what the slide shows you, this is a chart from BHP, one of the world's biggest mining companies out there. It's effectively showed you that the cost of producing copper have increased, and they're talking of this number about 65% higher than it is for brownfields relative to quarter the 2010 to 2015 period to where we sort of are today. So they're talking about costs increasing 65%. And really what it means is that if you, again, back to that 2010, 2015 period, you'll see that the capital intensity for copper was around $14,000 a ton. We had about 25 projects. And the current time frame, 2020 to 2025, that same number is now $23,000 a ton. We got, call it 10 projects. So clearly, we are needing more money produce the sort of same supply that we have historically seen.
Right, and then maybe quickly just on,
yeah. And then this is one of the issues, right? I've spoken about grades. Grades are 50% down. Economies of scales, mines are getting smaller, and the mines are getting deeper. I mean, this is a resolution, which you can see at the bottom right-hand side of that chart, is one of the mines that the US government, BHP, Rio Tinto's, the owners of this are talking about. That could be the solution for copper within the United States. And I'm not saying it can't be, it could be, but it's 1,300 meters deep. So what goes on with 1,300 deep mine, right? Relative to all the other projects, as you can see from those colorful bubble charts at the top, is much shallower. Well, depth increases complexity. It increases your OPEX, and it increases your CapEx, because all of a sudden you've got to build a lot more infrastructure. You've got to build shaft. You're going to build air conditioning systems. You require a lot more power to bring and hoist the material up. And technically, just the mines are typically more challenging in this environment. So again, this is a structural issue, as grades and mines getting smaller is another structural issue, which is why I believe supply is in a place where I think I can't really see that as the risk going forward.
So we've kind of already, I guess, discussed partially like what's next, right? But I do want to kind of try and pivot and stay within the framework of the discussion that we had set up front. So let's turn to what's next for these industries in the months and years to come. It seems maybe hard to believe that we wouldn't be keeping an eye on something like US and Iran, since a lot of factors seem to flow from that. I think, though, maybe capital expenditures, right, are probably something to be discussed. And how are we seeing a lot of movement there? What things are you keeping an eye on other than something like capital expenditures over the next 12 months and beyond?
So we spoke about this in detail last time. Nothing has really changed, to be quite honest with you. Since we spoke last time, I've had a meeting with most companies that sort of makes up this universe, and these numbers have not significantly changed. I think the more important thing that I want to add to this slide this time is that as that sort of CapEx have plateaued, and I alluded to this, there is an increased financial discipline from these mining companies. What financial discipline means is they are mining for profits, not mining for volume. And that's a critically important aspect to consider, which is what I think is the actual opportunity within the natural resource space, but it's specifically in the mining space, is that we have companies that is improving financially. For balance sheets are improving. A lot of these companies are cash positive on the balance sheets. Again, as I said, the capital structure is improving, as sort of alluded by the CapEx chart here. That means that their cash flow generation at higher commodity prices, as you said, is increasing, improving. A lot of these companies have got a very strong capital framework in place where 50% of their free cash flow from operations, 50% of that will go to CapEx. And then the other 50% will come to returning cash to shareholders. And because of that sort of thematic we're getting a lot of these companies sitting on free cash flow yields, 5, 6, 7 to 12%, which obviously is a very attractive environment for us to look at these.
Maybe want to just pause and give folks a chance to ask some of the questions that they might have. We did have a couple of questions from clients leading up to this webinar, and one that we kind of continually seem to get, and that's really about, China, their potential for overproduction. What happens if they decide that they're going to go ahead and just flood the market with rare earths? Is that something that's in our bingo card, so to speak? Is that something that a risk that we're contemplating? And what is the likelihood of something like that taking place?
Tongue in the cheek, yes, and yes, or I'm not sure is the real answer, because I don't know what the Chinese will do or wants to do, right? There's so many levers to be pulled within this negotiation that it could happen, it could not happen. I think what's more important is if we think about what's happening with the Western world companies, right? And where this industry is, as I said before, a lot of the companies needs to spend a lot of money for the next number of years to get to that self-sustainability as an industry, right? That increases financial risk, right? There's 2 or 3 companies, maybe 5 companies that's got actually revenue at the moment. There's equal amount of companies actually producing something. So you've got financial risk, you've got execution risk, not only just rolling off projects, which again, I showed you some issues before. But you've got operational risk. I mean, a lot of the companies that is US centric is really pilot based companies, meaning they are producing a certain product in a warehouse somewhere, and it's a very small scale, and they're going to extend that up in the next 5 years or so. And there's a very big difference between a pilot scale company and a commercial scale company. So that's sort of the risks for me for the US based industry. Well, if you look at the Chinese industry, they're getting the same price that there's that rare earth price chart we showed right at the beginning. They get that sort of $110 per kilogram price. But the difference is they've got revenue, they've got cash flow, they've got operations that's running, and clearly they're controlling the market. So it's a very interesting space. I cannot give you a intellectual answer on what China does and does not do.
We might pivot back to that at some point, because I know that there's a couple other questions about China, but I did want to try and touch on AI as well. We have a question here. I'll try and read it. It's sort of a longer question, but it says that since all these metals are so critical to the AI revolution, what is your best guess to when the shortage of metals will cause a slowdown in the building out of AI infrastructure due to it being too cost prohibitive?
Sure. Well, I think if we think about data center builds, right, I would say there's sort of 3 phases. We're in phase 1, which is the phase of, call it, construction of the facility. So if you think of, we're in the phase of building laying the concrete slabs, for example, right, building the walls and the roofs and the floors and things like that. I think we're still pretty much in that phase where, if I look at what some of the data I recently saw from the aggregates and the steel industry, we're seeing some really good price support for things like US steel prices, driven by what I just said. I think we're still in that sort of phase. I think the sort of second phase, which is more the okay, now we need the generation, and now we need the actual connectivity, if I can call it that way. I think we're still a couple of years away before we can really make a discussion or conversation about when the supply of these metals or minerals are going to have an impact on the actual rollout of the data centers. I will tell you though, data centers and various utilities are now already talking and contracting, call it power, call it uranium, 5 years out from now. So they clearly are thinking forward. Conversation we're having. I think the ultimate answer to that is a little bit early still at this moment.
There's one comment here about the industry not paying dividends and share buybacks, and how that could be challenging for capital raise for that industry. I think that probably certainly applies maybe to the rare earth companies, but as far as what we're seeing within the diversified miners and some of the copper producers, probably a different story, right? So maybe we'll discuss this slide, and then we can discuss opportunities moving forward.
All right. Thank you for hanging out for class time. I hope you learned a little bit with me. I got a lot of information out of that. I'm going to have to digest it. But some of my takeaways would have been some of the portions of the first part of the actual lesson. All right. As always, farewell, ahui ho, I love ya. Take care of your mental health, as Drew Carey says. Class dismissed.